This video covers Learning Objective 5, Evaluate Collectability using the Allowance for Uncollectibles account in Chapter 5, Receivables and Revenue. So let's get started. The best way to measure uncollectible accounts expense, bad debts, is by the allowance method. This method records losses from failure to collect receivables based on estimates developed from the company's collection experience. A company doesn't wait to see which customers will not pay. Instead, it records the estimated amount as uncollectible account expense and also sets up a contra asset to accounts receivable called allowance for uncollectible accounts. On the balance sheet, the allowance for uncollectible accounts reduces gross receivables to their net realizable value. Other titles for this account are allowance for doubtful accounts and allowance for bad debts. The allowance shows the amount of the receivables the business expects not to collect. Accounts receivable is shown on the balance sheet as a current asset. The gross amount of accounts receivable may be listed, and then the allowance for uncollectible accounts is subtracted to arrive at accounts receivable net. Sometimes only the accounts receivable net line is shown in the financial statements, and you will find the amount of the allowance for uncollectible accounts in the notes to the financial statements. Typically, receivables are the third item on the balance sheet, right after cash and short-term investments. Accounts receivable net is also referred to as the net realizable value of accounts receivable. We are going to be talking about uncollectible account expense, which exists because not all customers will pay what they owe. Two other terms for uncollectible account expense are doubtful account expense and bad debt expense. Due to the matching principles, we have to estimate the amount of uncollectible account expense because we don't know in advance who will not pay their invoice. We want to match the uncollectible account expense with the related sales. There are two methods we have to estimate the uncollectible account expense. They are the percent of sales method, which emphasizes the income statement, and the aging of receivables method, which emphasizes the balance sheet. We are going to cover the percent of sales method now. Here's the example. Thorson Company's credit department estimates that 1% of total revenues will be uncollectible. Total revenues for the most current year are $1,525,000. Journalize the entry for December 31st to record uncollectible account expense for the year. To make this entry, we start by recording the date. Next, we have to calculate the amount of uncollectible expense. This will be the amount of sales times the uncollectible account percentage. Here we have $1,525,000 times 1% to give us $15,250 as our estimate of the uncollectible account expense. We will debit uncollectible account expense for this amount and will credit the allowance for uncollectible accounts. We finish off the journal entry by recording the memo line. Uncollectible account expense will show up on the income statement as an expense. The allowance for uncollectible accounts is a contra asset and will reduce accounts receivable on the balance sheet. Now we will look at the aging of receivables method. Here's our example. Thompson Company's allowance for uncollectible accounts has a credit balance of $15,400 before the year-end adjustment. An aging schedule shows that the balance of the allowance should be $17,400. Journalize the entry for December 31st to record uncollectible account expense for the year. To calculate the amount of uncollectible expense using the aging of receivables method, we will compare the total that the aging schedule shows to the balance of the allowance for uncollectible accounts. In this case, an aging schedule shows that the balance of the allowance should be $17,400. Since the general ledger allowance for uncollectible accounts has a credit balance of only $15,400, we need to recognize an additional $2,000 of uncollectible account expense. I got the $2,000 by taking the $17,400 and subtracting the $15,400. We will debit uncollectible account expense for $2,000, and we will credit the allowance for uncollectible accounts for $2,000. Now we have another specific term, write-off. When the credit department determines that the company will never be able to collect from a customer, the company will remove that account from both accounts receivable and allowance for uncollectible accounts. This process is called writing off the account. It has no overall impact on accounts receivable net. There is another, less preferable way to account for uncollectible receivables. Under the direct write-off method, the company waits until a specific customer's receivable proves uncollectible. Then the accountant writes off the customer's account and records uncollectible account expense. The direct write-off method is not considered as being in keeping with generally accepted accounting principles, GAAP, for financial statement purposes for two reasons. 1. It uses no allowance for uncollectibles. As a result, receivables are always reported at their full amount, which is more than the business expects to collect. Assets on the balance sheet may be overstated. 2. It fails to recognize the expense of uncollectible accounts in the same period in which the related sales revenue is earned. However, the direct write-off method is the required method of accounting for uncollectible accounts for federal income tax purposes. It is one of several sources of timing differences that may arise between net income for financial reporting purposes and for tax purposes. Now we have a few knowledge check questions coming up to test your understanding of this material. After I read the question, pause the video and try to answer it. Once you restart the video, I will be walking through the answer to the question. Let's go. The first question reads, the blank method records collection losses based on estimates developed from the company's collections experience. The choices are uncollectible, doubtful account, risk, or allowance. The answer is allowance. The allowance method records collection losses based on estimates. The second question reads, the allowance for uncollectible accounts normally has a credit balance. Is this statement true or false? The answer is true. The allowance for uncollectible accounts is a contra asset. The third question reads, the net realizable value of accounts receivable is the difference between accounts receivable and, the choices are sales discounts, allowance for uncollectible accounts, uncollectible account expense, or net revenue. The answer is allowance for uncollectible accounts. Remember that the formula for net realizable value is accounts receivable minus allowance for uncollectible accounts equals net realizable value. That concludes our review of evaluating collectability using the allowance for uncollectible accounts. Thanks for watching.